Here's a riddle to start your week. What connects France, global trade, and Iran? No, it isn't the Silk Road. It's this week's newswire. Good morning. I'm Benjamin Sullivan, and welcome to Market Monday for June 29th, 2026. Let's start with the most anticipated headline over the last few months. The US and Iran have agreed to end their war. After months of fighting that began in February, they signed a Memorandum of Understanding, or MOU, in Versailles. The MOU is essentially a handshake agreement that spells out the terms of peace, and it was brokered by Pakistan. This week, the US took its first concrete step, easing sanctions on Iran, allowing Iran to sell its oil in the open market for the first time in years. Why does this matter to you? The war initially drove oil prices sharply higher. When oil gets expensive, some of those extra costs get passed through to everything else. Part of the deal reopens the Strait of Hormuz, the narrow waterway that carries roughly a fifth of the world's oil. With peace on the table and Iranian oil flowing back, oil prices have completely cratered. In fact, they're at their lowest level since the war began, almost back to pre-war levels. There's a catch, however. The deal isn't done yet. The negotiators have 60 days to settle the details, and tensions could flare again as both sides test the limits of each other's patience. In the meantime, one of the biggest pressures on your wallet has started to ease. This brings us to the story that matters most for your money, the Federal Reserve. The Fed is America's central bank, and it has a mandate to keep prices stable and maximize employment. It pulls a lot of levers to do so, but the benchmark interest rate is always in the spotlight, and there are big changes coming. Kevin Warsh recently succeeded Jerome Powell to become chair of the Federal Reserve. In his first meeting since taking the reins, the Fed did something most investors didn't see coming. Until recently, the market was betting Kevin Warsh's Fed would cut rates this year, regardless of economic data. Instead, it signaled it might raise them. The reason? Oil-driven inflation pushed prices up at their fastest pace in 3 years. And inflation has consistently been well above the Fed's comfort zone. After their last meeting, half of the Fed policymakers say they expect at least one rate hike before the end of the year. So what does that mean for you? Simply put, rates are likely to stay higher for longer. The good news is your cash, savings, and bonds keep paying attractive returns. The trade-off is borrowing costs will stay elevated, and the most expensive growth stocks may feel pressure. Here's where our stories connect. If the Iran deal keeps oil prices low, inflation could cool on its own, and the Fed might not have to hike at all. We'll be watching that tug of war all summer. On to our last story. You've all heard of ChatGPT. The company behind it, OpenAI, was expected to go public this year in one of the most anticipated debuts ever. This week, however, reports say they're putting it on ice, possibly until 2027, and holding out for a $1 trillion price tag. The lesson? Even the hottest stories in tech have limits. That's exactly why we stay diversified and disciplined instead of chasing hype. This week's stories were the answer to our riddle: a fragile piece, a Fed with a new attitude, and a reminder that patience tends to pay. If this helped you at all, do us a quick favor. Hit subscribe, smash that like button, and share this episode with one person in your life who's trying to make better decisions with their money. Those conversations are exactly why we make this show. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday. Join us again next Monday for more of the insights that matter to your money.